If there's one investing topic that draws a lot of attention, it should be share buybacks. Warren Buffett's partner at Berkshire Hathaway, Charlie Munger, once said in the conglomerate's 2021 AGM, if you are repurchasing stock just to pull it higher, it's deeply immoral. But if you're repurchasing stock because it's a fair thing to do in the interest of your existing shareholders, it's a highly moral act. And the people who are criticizing it are bonkers. Hi everyone, welcome to this new video series where we discuss one aspect of investing in each episode to help you navigate the stock market jungle easily. For this episode, we are going to talk about the controversial topic of share buybacks and how they enhance investor return over the long term if done correctly. We have here Rupam and Fan Liang, who are the co-founders of MoneyWiseSmart. So now, let's dive straight into our topic of share buybacks. So Fan Liang, let's start with a question that we have. So what are exactly share buybacks? Could you just explain to all of us?
Yeah, sure, Sultan. So I think share buyback is actually a pretty important concept in investing, but it's probably less discussed among the investing world or less noticed by people. And share buybacks is basically a company buying back its shares. And so imagine most of us investors, we are investing in publicly listed companies, and we can buy those shares from the markets. So the company itself can do the same too, where it can go and buy their own shares, which will help to reduce their share count in total if they think it makes sense to do so. And maybe to give a bit of more context, let's think about why would a company do share buybacks? So let's think about it from a perspective, say if you are the management of the company, every year our company is generating some operating cash flows, which is cash in the bank. And then we need to decide what do we do with those cash? How do we allocate those capital? And there are different ways where we can use those capital for example, by reinvesting back into the business, if we think that they can generate good return, or maybe we have a lot of debt, we can use those cash to pay down some debt. Or one thing some of the investors like is dividends. If we think it's good, we can distribute out the cash as dividends so that we don't hold too much cash in the bank. Or the other way is just share buyback. When we think the shares are undervalued in the market, then if the management go and buy back the shares, it can actually result in a good value accretive impact on the existing shareholders.
So Rupam, Fan Liang mentioned that share buybacks actually help investors. So that's one of the benefits. Can you give an example of how actually this comes about for investors?
Okay, let me actually share my screen, and I will just take a very simple case study where I will explain how investor returns don't necessarily only come from the top line growth of a business. It can also come when the business is buying back shares. So let me just show this example. Now here I have a very simple business, and let's assume that this is, let's say, a farm which has an intrinsic value of $1 million. And currently, let's assume that the market cap is also $1 million. It's exactly same as the intrinsic value. And the business has 10,000 shares outstanding. And this business, which is a farm, it does not employ any debt. It generates a return on capital of 12%. So $1 million, which is the capital which has gone into the business, a very simple business. And in the first year, the business generates a free cash flow or owner earning in this case, because there is no growth investment that the farm is making. So it throws out a free cash flow of $120,000. Now, as the business does not have any opportunity to reinvest this $120,000 into the business decides to buy back shares from the market. So currently the share price is $100 per share, and the business repurchases 1,200 shares, which is basically 12% of the total outstanding shares. And as a result, the number of new outstanding shares is 8,800. And similarly, again, the business generates $120,000 and does the same. So every year after the buyback, which is 12% of market cap, the business on an ongoing basis reduces the number of shares outstanding. Now, over a 10-year period, the business buys back a total of over 72% of the shares. And this is basically a 12% buyback every year. But if you look at the shareholder returns, the resultant share price, because we have assumed that the market price, stays exactly same as the intrinsic value of the business. So over a 10-year period, the share price grows from $100 per share, which is, the intrinsic value per share, to $359. So that results in a shareholder return of 13.64% compounded. Now, this is a very interesting thing, which is not very intuitive, but you can see the second order effect of a share buyback. And if I explain to you very simply, let's say if there are 10 friends owning a farm, and if the business buys back one of them, then the remaining 9 friends, their share, while the business bought back 10% of the share of the business, but the resultant shares of each friend jumps by over 11%. So that is something that happens because of the share buybacks. So while the business was buying back 12% of the shares every year, the resultant compounded growth for the share investor is 13.64% over this 10-year period. And as you can see, the investor received his or her returns, even though the top line of the business did not grow at all. This return is entirely from the share buybacks. So let me actually give a real life example that a company that all of us are familiar with, which is eBay. This is a Morningstar snapshot. So if you look at the last 10 years revenues of eBay, they have not grown. They have not gone anywhere. It was about 11.6 billion, which has stayed around that same level. And the trailing 12 months is also 11.6. However, if you look at the number of shares outstanding, it came down from 1.3 billion down to 683 million. So eBay has basically not grown its top line, but because it has constantly bought back shares, the per share earnings have actually gone up, and so has the per share free cash flow. So as a result, if we look at eBay's share price, this is what it looks like. So a business which has had no growth in the top line, the share price has grown from about $13 to $55.5, and that is after the recent pullback. So this is I think on a compounded terms, this is almost a 14%, some 14 to 15% return that eBay has generated for its shareholders over the last 10 years. So this is a very classic example of how share buybacks work. Stop sharing the screen.
Yep, so that's a very interesting point you brought up, Rupam. Even though the business is not growing its top line, even decreasing its top line, just because the company bought back a lot of its shares, basically cannibalizing its own shares. Like Charlie Munger likes to put it, it actually increases per share earnings and per share free cash flow for the investors. Fan Liang, do you have other examples of companies doing share buybacks?
Yes, I have some examples, but just before that, I think what Rupam mentioned and you mentioned are very good. And to give a simple analogy, how I think about it is, say, for example, today, 3 of us are in business and we sell pizzas and we only have 1 pizza and we cut it into 9 slices. So we get to eat 3 slices each. And if, say, for whatever reason, Suhan, you need money and you want to sell your pizza, and me and Rupam are of course happy to buy it if you sell it to us at a cheap price. So in this case, we buy it from you. So we are like buying shares or buying the pizza from you at a low price. And then if we buy it and then you are no longer a shareholder, then the 9 pizza now gets shared between me and Rupam. So we are happy investors and eaters now. We have 4.5 pizzas for each of us. But of course, whether it's beneficial for us as an investor, it depends on what is the price. Ultimately, is how much you pay for it. So if a company managed to buy back shares at a cheap price, like what Rupam showed in the example just now, then it can be very value accretive to investors. And another point I wanted to add on is also, personally for me as an investor, I invest in a portfolio of good, strong companies with strong moats and good tailwind and a lot of growth in the future. And I don't time the market. So usually I invest all my cash in the market. That means I always have minimal cash to invest in more opportunities when some of the share price of the companies crash. But because of the companies that I own, they are usually good capital allocators. They will do the share buybacks on my behalf. So for example, there's this company called Bank OZK, which is a mid-sized bank in the US. Last time they used to not do much share buybacks because they always wanted to reserve their cash to reinvest in the business. But recently they realized that maybe there are not that much opportunities and the board is now more open to doing share buybacks. And they authorized a share buyback plan that allows them to buy back 10% of their shares. And I think in the last quarter, or maybe, I think in the last quarter, they bought back about 3% of their shares at a price that I think is undervalued. So that's good for me, because for me, I do have much cash. So when the company share price goes down, I can't buy too much of them more, but I want to buy them. But I do need to buy them because my company's management will be buying back those shares to me. And when they do those, I get to eat more pizza and more pizza, even though I didn't fork out the cash myself. So that's how I look at it. But some of the companies, they are also not very friendly or open to doing share buybacks for whatever reason. For example, I'm pretty sure most of the people would know JD.com, which is one of the largest e-commerce players in China, a very good company run by Chinese management. And their share price has come down quite significantly recently in the past few years at different points of time. So in the past, they have spent some money buying back shares, but at a very low amount. It's not material. And there were times when the share price was down by a lot and they actually have a lot of excess cash, but for whatever reason, the management is just not buying back the shares. If they have done that, then that would have improved the intrinsic value of the company per share for me as an investor much more. So there are sometimes you see companies doing a lot of share buybacks like eBay, and sometimes companies are less willing to do share buybacks.
Yep. So you mentioned Bank OZK and also JD.com. So these two companies are also part of our Multibagger Research Series that we have. So to know more about this research series, we have the details down below. You can click on later. So back to the point on, you don't have enough cash, but the companies are buying back shares for you. So I think Warren Buffett has a very interesting point where he said, I think he owns around, Berkshire Hathaway owns around 5% of Apple, but Apple has been buying back a lot of their shares. So because of that, Berkshire now owns even more percentage of outstanding shares of Apple.
Exactly.
So, so that's a very interesting and beneficial thing for shareholders as well. So talking about Warren Buffett, Warren Buffett is a huge fan of buying back shares. Faliang, could you just share with us some of the things that he has mentioned about share buybacks?
Yeah, sure. I'm happy to share and do my best. I think the best way is still to read it from the god of investing himself, Buffett. And I'm pretty sure, I think most people should try to read it if they have time. 3 of us, I'm pretty sure, we have read it a couple of times, the original letters. And there's also another book that summarizes all his letters. But let me just share what he says on share buybacks in those letters. So overall, in the past, share buyback is not as common, but in recent times, a lot of companies have started adopting it, but not all companies do it in the right way or beneficial to the shareholders. So Buffett says that a share buyback is good if it fulfills 2 main criteria. The first is, in investing, is always value versus price. So it's only when those shares are bought back at a good price, which is a price that is lower than the intrinsic value with a probably good margin of safety, then it's only then that is beneficial to the shareholders. So going back to the analogy just now where we 3 of us are sharing 9 pizza, if I'm buying the pizza from you, Sudhan, at a very high price, of course, is not good for me. And there are actually companies out there, they are doing this, they are just buying back shares like mindlessly. And sometimes it's because they doing that can improve the earnings per share, which makes the management looks good, or maybe they have some compensation structure that is tied to earnings per share. So just by doing that easy move, they get to increase their compensations and make them look nice. And so
Sorry,
back to the
Fadlan,
criteria.
Sorry,
Yeah.
Fadlan, just to stop you at the point. I think that's the reason also why share buybacks have a very bad reputation, because companies are buying back shares at higher than intrinsic value, and just to show up their earnings per share and stuff like that. So I think that's the reason is a lot of people don't like share buybacks, and it's a controversial topic as well. Yeah.
Actually, after funding, I'll just show in the same example which I showed what happens when the shares are bought below the intrinsic value and what happens when the shares are bought above the intrinsic value. I mean, it will become very clear, because I think that part is the most important part, that share buybacks, not at any price, but when the stock is available at a deep discount. And the current market condition actually throws up a lot of opportunities for such share buybacks. So I will be very keenly watching my businesses, especially over the next couple of quarters, to see how they have used their available free cash to increase the buybacks.
Sure. Yep, definitely. We can go into the calculations later. And then just coming back to the management point, which is why I think it's important for us to look at how management compensation is structured. Like if you go through the notes in the annual report, you can actually see what are their share compensation plans, whether it's incentivizing them to drive short-term earnings per share performance or something that is more longer term. And then back to the criteria, Buffett also says that the other criteria when share buybacks is good is when the company actually has excess cash that it can't reinvest well into its organic business to grow its competitive advantages. Because at any one point, for us investors, long-term investors in good businesses, ultimately you want the company to have strong moat, to be able to fend off its competitors and earn high return on capital, and to do that sustainably over a long time. And that's when the compounding effect can actually have a strong impact on our investor return. So whenever a company has excess cash and some opportunities that they can reinvest in at a good rate, they should always do that, especially if it helps them to build up more moat, a stronger moat, because that's what drives the long-term returns. But if they have excess cash that they can't deploy, then that's when, if they can deploy it into share buybacks at a good price, that will actually drive more higher value to investors. So that's sort of a summary of what Buffett says about share buyback, and he says a lot more on this, and he keeps repeating the same messages over the years. So I would recommend people to read the letters to really internalize and keep getting the messages through.
Yeah, well summarized, Fadlan. Rupam, do you want to share the screen?
Yes, I'll just share the screen. In the same example where we saw that the business is buying back 12% of its shares every year, and in a 10-year period, that results in a shareholder return of 13.64%. Okay, so keep in mind this, the second order effect. Now, let's say in one of the years, instead of buying where the market cap is $1 million, let's say there is a big correction and the market cap is only $600,000, and let's say that is the time when the business bought back the shares. Now, using the same free cash, this time the business is able to buy significantly more number of shares as compared to what it was doing earlier. So the percentage in terms of buying back goes up to 20%, and you can see the resultant return shoots up to 14.72% as compared to 13.64%. And instead of buying back below the intrinsic value, instead, if the business, let's say, goes and buys when the market price is above the intrinsic value, let's say when the market price is $1.3 million, okay, compared to the intrinsic value of $1 million, you can see the long-term shareholder returns go down, simply because the same free cash flow can afford them a much lesser percentage of the shares. So this is a very this is a very simplistic example, but often, especially new investors, they kind of have this notion that for us to do well as investors, the business has to keep growing their top line. Yeah, of course, we prefer businesses which grow their top line, but sometimes, it's important to understand that finally the business is growing their earnings by reinvesting part of their earnings into the business, by retaining part of the earnings, and that in turn generates more earnings. But if the business does not require too much capital to run, and if the business does not have too many reinvestment opportunities to invest in, then it's perfectly a great way to reward shareholders by returning capital to the shareholders. Now, that returning of capital can be done via dividends or via share buybacks. Now, contrary to what the popular narrative is, that dividends are not exactly very tax friendly. They're not great from a tax point of view. And while this might be a little bit complex, but the dividend goes out from the book value of the business. So when especially when the business is available at a price that is higher than the book value, there's a calculation which shows that it may not be very advantageous to receive the dividend. The shareholder can be better off by maybe generating the same cash flow by selling a few shares. So we have covered this in a detailed video where I have actually used a case study to demonstrate this, and maybe we can add that video in the description section below. But when it comes to share buybacks, they're even from a tax point of view, they're much better. And let's talk of us. None of us are based in the US. We are all international shareholders. So if we have invested in a US listed equity, whenever the business issues a dividend, we have to incur a 30% withholding tax, which can be quite expensive over a long period of time. Whereas, some of us are lucky to be based in Singapore. Singapore doesn't have any capital gains tax. So it is significantly more advantageous for us to receive the same capital in form of capital appreciation that happens via the share buybacks. So, these are some of the nuances which often investors miss out. And I think, Sudan, I know you have been looking at Facebook. So maybe you can share with our viewers what Facebook has been up to when it comes to share buybacks.
Yeah, so Facebook is one of the companies that has share price wise has been punished, or rather it's Meta Platforms now. So its share price has come down, I think around 30%, I think, and lost market cap in the billions during the drawdown. Meta, in terms of its share repurchases, last year it repurchased around 45 billion of its shares. And then this year it has around 30 plus billion worth of shares left to repurchase. So back to the point of how shareholders benefit by companies repurchasing their shares. I think Meta shareholders will benefit as well as the company goes on to repurchase its shares, but provided it's under its intrinsic value.
And it's almost 7% of their current market cap, the amount that they have bought back, last year. So which is huge.
Yeah, that's right. So I think apart from Facebook, I think Fanyang, you have a few more examples of companies buying back shares as well.
Yeah, I just remember one, and definitely for Facebook or Meta is impressive that they managed to buy back 7% in a year. And I just remember that in our Multibagger Research Series, we also cover Wix, which is a low-code or no-code website developer. And for Wix, it actually doesn't buy back that much shares, which I hope it does more if it has excess cash. But for its competitor, GoDaddy, which is a more mature business, they have less reinvestment opportunities. And in the past few years, they have bought back. They are very cash generative, and they've bought back like almost 10% of its shares in the past maybe 4 years, I think. But now, I think they have so much cash that they just authorized another new buyback program that allows them to buy back close to slightly more than 20% of their shares in a few years. So imagine if they manage to do it, it's like buying back 30% of his shares, and that means from 100% you are dropped to 70%, and the existing shareholders get so much more share of the existing business. So those are the things that I would hope to see in companies doing when their share price come down.
I think, guys, any discussion on share buybacks will remain incomplete without talking about the famous Henry Singleton of Teledyne. You know, for those of you who have not yet read the book, The Outsiders by William Thorndike, we would highly recommend this book. I know, Fanliang, you have read this book. So in this book, they talk about some of the best capital allocators ever. And, you know, this is a very interesting story. So Henry Singleton, when he was the CEO of Teledyne Inc., between 1963 and 1990, he has generated a compounded return of over 20% for his shareholders. And he was an amazing capital allocator. So in the early parts of 1960s, when the Teledyne stock was overpriced, he used that his stock as currency and went into major acquisition spree. I think, if I remember correctly, he made some over 100 acquisitions, some 130 acquisitions, whereas between 1972 and 1984, I think that was the time when the stock was undervalued, he went and bought back. I think he tendered some 8 times, and over the period, he brought down his total outstanding shares by 90%. So that is probably you know, the best instance of generating supernormal shareholder returns, mainly through share buybacks. I think that that goes in the buyback Hall of Fame. This instance. I'm sure there are many other examples, but while Henry Singleton was buying back very judiciously at prices which was way below intrinsic value, several of the other large companies in corporate America, they were buying back at prices which were much above intrinsic value. In fact, there have been you know, many instances in history where companies, they raise debt to go and buy back shares, and that to overpriced shares. And that is you know, a great example of very stupid capital allocation, which over time it hurts the shareholders. You know, it can be increasing the per share earnings for the business in the short term, and maybe that directly results in you know, a juicier bonus for the CEO, or you know, higher compensation, because the compensation is often tied with the per share earnings, but in the long run it absolutely hurts the shareholders. So that's the reason why when we are evaluating a business, it's not only the operating characteristics of the business which we should look at, we should also focus on how the capital allocation track record of the CEO is. And by capital allocation, you know, we need to look at have they been returning capital to shareholders, or you know, what have they been doing with the free cash flow. Business can generate a very high return on you know, on its invested capital, but if they do not know what to do with the cash, and the cash just sits on the balance sheet, then it's no good for the shareholders. In fact, you all might be knowing that Apple had this problem. There was a point of time when Apple was sitting on over $100 billion of cash, on its balance sheet, and the returns on that cash was actually not very high. In fact, a lot of that cash was also sitting outside of US, and I think they knew that the moment they bring it in, they had some tax liabilities. So that's when Apple decided, and they actually announced that they want to be cash neutral. And if my memory serves right, in 2021, Apple repurchased $88 billion of shares. Sudan, you can correct me. I'm not an Apple shareholder, but I just out of curiosity, I read this in their company filing. So that shows us the quantum of share buybacks that they have been doing. I know Buffett has been buying back over the last couple of years. So these are some of the great examples of share buybacks, which eventually result in shareholder returns.
I think that's exactly why Warren Buffett's a happy shareholder as well. Apple buy back so much of his shares, and he's increasing his ownership without doing anything.
Absolutely.
Yeah.
Absolutely.
Yeah, I think so. This brings us to the end of our conversation on share buybacks. So we'll be doing more of such conversations. And if you like what you see, do like, share, and subscribe to our channel.
Thank you very much.
Thank you.
Thanks, guys.